OpenAI and Anthropic are preparing to go public, and the timing is not a coincidence. Both companies are in the same industry, building large language models. Both have raised billions in private funding over the past year, and now both are rushing toward public markets at exactly the same time. That simultaneous timing tells you something important is happening behind the scenes. These will not be ordinary IPOs. The scale is larger than anything technology markets have seen before. Bigger than Facebook, bigger than Alibaba. The amount of capital being raised will set records. But the scale is not the interesting part. What makes this significant is the question of why now. Just months ago, these companies were raising billion-dollar private funding rounds. Valuations were climbing, money was flowing in. If private investors were willing to commit billions as recently as last year, why the sudden rush to public markets? Something fundamental has changed in the math, and that change tells you who has already made their money and who is about to take the risk. Or start with what we know. OpenAI, the company behind ChatGPT, is actively planning an initial public offering. Anthropic, the company behind Claude, is doing the same. Both companies focus on developing and deploying large language models. Both have raised enormous sums from private investors, and both are now moving quickly towards selling shares to the public. The IPO machinery is already in motion. Investment banks are being selected to underwrite the offerings. Valuation discussions are happening with potential investors. Regulatory filings are being prepared. The timeline has both companies targeting public listings sometime in the next 12 to 18 months, possibly sooner if market conditions align. The speed is unusual for several reasons, and each reason points to something important about what is driving these decisions. First, both companies are young by traditional IPO standards. OpenAI was founded in 2015, making it roughly 10 years old. Anthropic was founded in 2021, making it barely 4 years old. For context, Google waited 9 years after founding before going public. Facebook waited 8 years. The typical path involves building a profitable business model, establishing market dominance, and then choosing to go public when the timing suits the company's long-term strategy. These AI companies are compressing that timeline significantly. Second, neither company is profitable in the traditional sense. They generate substantial revenue, which we will get to, but they are also burning through enormous amounts of cash to fund operations. Most companies that go public are either profitable or very close to profitability. The business model has proven itself. Cash flow is positive or about to become positive. That financial stability makes the public offering a natural next step. OpenAI and Anthropic do not fit that profile. They are growing extremely fast, but they are spending just as fast. The cash flow is still deeply negative. Third, and this is where the timing becomes particularly strange, both companies raised massive private funding rounds within the past year. OpenAI closed multiple billion-dollar rounds in 2024 and 2025. Anthropic raised over $13 billion in a single Series F round in 2025, one of the largest private funding rounds in history. When a company raises that much capital from private investors, it typically has enough runway to operate for years without needing additional funding. The fact that these companies are pursuing public offerings so quickly after securing billions privately suggests that something has shifted. Either the capital requirements are far larger than those private rounds could cover, or the private investors who funded those rounds are no longer willing or able to continue at the pace required. Now look at the numbers being discussed. This is where the IPOs become historically significant. OpenAI's private valuation has climbed into the range of $500 billion to $1 trillion depending on which reports you believe. If the company goes public near those levels and floats even a modest percentage of shares, the capital raised would be enormous. A 5% float at a $500 billion valuation raises $25 billion. A 10% float raises $50 billion. For context, Alibaba's 2014 IPO raised approximately $25 billion and held the record for largest tech IPO for years. Facebook raised roughly $16 billion in 2012. An OpenAI IPO at the lower end of estimates would match Alibaba. At the higher end, it would nearly double it. Anthropic's path is similar. The company raised $13 billion at a $183 billion post-money valuation in its Series F round. Market reports suggest follow-on discussions have pushed implied valuations toward $250 to $350 billion. An IPO at those levels with a 5 to 10% float would raise $12 to $35 billion, depending on final pricing. These are not normal numbers. The largest technology IPOs in history raised tens of billions. These AI IPOs could raise similar or larger amounts. They would rank among the biggest capital raises ever, not just in technology, but across all industries. The scale tells you something important. Like when companies raise this much capital, they are not doing it for flexibility or optionality. They are doing it because they need it. Before understanding why the IPOs are happening now, you need to understand who funded these companies to this point. OpenAI's largest backer is Microsoft. Microsoft has invested billions of dollars into OpenAI through a complex structure involving equity stakes, cloud credits, and commercial partnerships. The exact dollar amount is not fully public, but estimates place Microsoft's total commitment in the range of $10 to $13 billion. That investment was made over multiple rounds at valuations far below current levels. Anthropic's funding came from a different but equally powerful group. The company's Series F round in 2025 was backed by an international syndicate including sovereign wealth funds, late-stage venture capital firms, hedge funds, and asset managers. Names include GIC, Coatue, BlackRock affiliates, Bailey Gifford, D1 Capital, Jane Street, and multiple pension funds. That single round raised $13 billion. These are not small investors writing small checks. These are institutions managing hundreds of billions or trillions in total assets. When they commit billions to a single company, it represents significant concentration. A sovereign wealth fund managing $500 billion that invests $10 billion into one private company has 2% of its entire portfolio in that single bet. And the investments did not stop there. Both companies have reportedly been in discussions for follow-on rounds, even after their most recent massive raises. The capital requirements are so large and so continuous that even billion-dollar rounds get absorbed quickly. This creates a problem. There are only so many institutions in the world capable of writing billion-dollar checks for private companies. And there's a limit to how much any single institution can commit to one company without creating unacceptable concentration risk. Here is where the story turns. Private investors have limits. Even the largest sovereign wealth funds and venture firms cannot keep committing billions to the same companies indefinitely. The constraint is concentration. A fund managing $500 billion might reasonably commit $5 or $10 billion to a high conviction bet. But $20 billion? $30 billion? At some point, the exposure becomes irresponsible. If the company fails, or even just stagnates, the fund's entire performance suffers. The risk is too concentrated. The constraint is also liquidity. Private investments are illiquid. Capital committed to a private company is locked up until an exit event like an IPO or acquisition. Funds need to balance illiquid private bets with liquid public holdings. When a single private company absorbs tens of billions in commitments, it crowds out other investments and reduces portfolio flexibility. The constraint is time horizon. Private investors expect exits. They do not want to hold private stakes indefinitely. A venture fund that invested in 2021 wants liquidity within 5 to 7 years. A sovereign fund that invested in 2023 wants a clear path to realizing value. An IPO provides that exit. And the final constraint is the burn rate. OpenAI and Anthropic are not slowing their spending, they are accelerating it. Compute costs are rising as models get larger and more complex. Competition is forcing faster iteration cycles. Customer acquisition and enterprise sales require significant investment. The companies need billions annually just to maintain their current trajectory, let alone grow. Private investors looked at this dynamic and reached a conclusion. They cannot continue funding at this pace. The concentration risk is too high. The liquidity needs are too pressing, and the ongoing capital requirements are too large for private markets to absorb alone. That is why the IPOs are happening now. Not because the companies are ready, because the private investors are tapped out. Now we get to the critical part. The wealth has already been created. The question is who captured it. Microsoft invested in OpenAI when the company was valued far below current levels. Reports suggest Microsoft's initial investments valued OpenAI in the single-digit or low double-digit billions. Those same stakes, if OpenAI goes public at a $500 billion valuation, are now worth tens of billions. Microsoft's return is already locked in on paper. The IPO just converts that paper into liquid stock. The same is true for Anthropic's early backers. Venture firms that invested at single-digit billion valuations now hold stakes in a company valued at $200 billion or more. That is a 20x to 50x return. Some later-stage investors who came in at $50 or $100 billion valuations still have 2x to 5x returns. Employees and founders are also sitting on enormous paper wealth. Stock options and restricted shares granted when valuations were lower are now worth multiples of their strike prices. An employee who joined OpenAI in 2020 or Anthropic in 2021 could be holding equity worth millions or tens of millions. The gains are not speculative. They are locked in at the IPO price. Even if the stock falls 30 or 50% after going public, the early investors and employees still captured massive returns. They bought low. Public investors will buy high. This is the standard venture capital model, but the scale changes everything. In a typical tech IPO, early investors might turn 10 million into 100 million. In these AI IPOs, early investors are turning billions into tens of billions. The absolute dollar gains are historically unprecedented, and those investors are ready to realize those gains. An IPO creates a liquid market where shares can be sold. Lockup periods typically restrict immediate selling, but after 6 months to a year, early investors can exit. That liquidity is the entire point. Private investors made their money. Now they want to convert it to cash. So what does that leave for public investors? The answer is straightforward but uncomfortable. Public investors get to finance the next phase at peak valuations. If OpenAI goes public at a $500 billion valuation, that is the price public investors pay. There is no discount for risk. There is no early stage upside. The valuation already reflects years of growth and multiple funding rounds at escalating prices. Public investors are buying at the top of the valuation curve. The return depends entirely on future growth. The company must grow from $500 billion to $750 billion or $1 trillion for public investors to see meaningful gains. That requires sustained revenue growth, improving margins, and successful competition against well-funded rivals. But here's the problem. The companies are not profitable. OpenAI generates over $20 billion in annualized revenue, which is substantial. But the company also spends billions on compute infrastructure, model training, and operations. The exact burn rate is not public, but reports suggest annual cash consumption in the multiple billions. Anthropic has similar dynamics. Revenue is growing rapidly, but so are costs. The business model requires continuous capital to fund GPUs, data centers, engineering talent, and customer acquisition. Without that capital, the companies cannot maintain their competitive position. An IPO provides that capital. The 20 to 50 billion raised goes directly into funding operations, expanding infrastructure, and competing for market share. Public investors are not buying a mature, cash-generating business. They are financing an ongoing capital-intensive race. The bet is that revenue growth will eventually outpace costs, and the companies will achieve profitability at scale. That is possible. But it is not guaranteed. And if it does not happen, the valuation has no fundamental support. Compare this to the private investors. They invested at $10 billion, $50 billion, $100 billion valuations. Even if the company never becomes profitable and the stock falls 50% from the IPO price, they still made money. A private investor who bought at $100 billion and sells at $250 billion made a 150% return, even if the stock then falls to $125 billion. The public investor who bought at $500 billion and watches it fall to $250 billion lost half their money. This is the asymmetry. Private investors bought the exponential growth phase at low valuations. Public investors are buying the mature, competitive phase at peak valuations. Private investors are exiting. Public investors are entering. One side is locking in gains. The other side is taking on risk. Now layer in the competitive reality. The AI industry is not a winner-take-all market. It is fragmenting. Big tech is competing directly. Google has DeepMind and Gemini. Meta has LLama and continued AI investment. Microsoft develops its own models despite partnering with OpenAI. Amazon builds AI capabilities across AWS. These companies have advantages OpenAI and Anthropic do not have. They own cloud infrastructure. They have existing enterprise relationships. They can cross-subsidize AI with profitable core businesses. If Google decides to offer Gemini at cost as part of Google Workspace, OpenAI cannot match that pricing. If Meta open sources LLama and lets enterprises run it for free, Anthropic loses pricing power. Big tech can afford to lose money on AI to win in other areas. Pure play AI companies cannot. Open source models create the same pressure. Llama derivatives, Mistral, and other projects provide comparable performance for many use cases at dramatically lower cost. An enterprise that wants to avoid per-token API fees can run open source models on its own infrastructure. The performance gap between open source and proprietary models is narrowing. Open source does not need to be better. It just needs to be good enough and cheaper. China is the third pressure point. Baidu, Alibaba, ByteDance, and others are building large language models optimized for Chinese language and local markets. They have access to massive compute, large user bases, and government support. Chinese models can price aggressively to gain share. If a Chinese model offers similar performance at 50 or 70% of the cost, enterprises in Asia and price-sensitive markets globally will switch. These competitive forces are not theoretical. They are active and intensifying. OpenAI and Anthropic cannot raise prices to improve margins without losing customers. They cannot cut costs without sacrificing the performance and scale that justify premium pricing. They are caught between rising costs and pricing pressure. This makes the public market valuation even harder to justify. A company valued at $500 billion with $20 billion in revenue trades at a 25x revenue multiple. That multiple only makes sense if revenue grows rapidly and margins expand significantly. But competition is compressing margins, not expanding them. Revenue growth is real, but it is happening in an environment where pricing power is eroding. For public investors, This means the upside case requires everything to go right. Revenue must grow, margins must improve, competition must be held at bay. Any one of those assumptions failing means the valuation compresses. And valuation compression at this scale means tens of billions of dollars in market cap disappearing. The final piece is understanding what these IPOs actually are. They are not companies choosing to go public for strategic reasons. They are companies that need to go public because private markets cannot provide the capital required. Most IPOs are milestones. A company reaches profitability, decides public markets make sense, and lists when conditions are favorable. Well, the IPO is optional. These AI IPOs are not optional. They are necessary. The companies burn billions annually. Private investors have committed what they can. The concentration risk is too high. The liquidity demands are too pressing, and the ongoing capital needs are too large. Public markets are the only source of capital large enough to sustain the business model. This changes the risk profile. A company going public by choice can wait for good market conditions and strong fundamentals. A company going public by necessity must accept whatever conditions exist. The timing is not about maximizing value. It is about accessing capital. For public investors, this distinction matters. When a company goes public because it needs the money, it signals that the private investors who understand the business best have decided they cannot or will not provide more capital. That is not a vote of confidence in future growth. It is a signal that the risk-reward at current valuations no longer works for sophisticated investors. Those sophisticated investors are now looking to exit. They made their returns. They want liquidity. The IPO provides it. And the burden of financing the next phase shifts to public investors, many of whom do not have the same information, expertise, or portfolio diversification that private investors had. This is the structure. Private investors funded growth at low valuations, captured exponential returns, reached their concentration limits, and now need to exit. Public investors provide the exit by buying at peak valuations and financing ongoing operations. The wealth transfer is from public to private. The risk transfer is from private to public. OpenAI and Anthropic are going public because private capital ran out. The investors who funded these companies to this point have reached their limits. Concentration risk is too high. Liquidity needs are too pressing. And the companies need continuous, massive capital that only public markets can provide. The timing tells you everything. The IPOs are not happening because the companies are mature and profitable. They are happening because private investors are tapped out and need an exit. The wealth has already been created at lower valuations. Public investors are being asked to finance the next phase at peak prices with no certainty of profitability. The competitive environment is brutal. Big tech can cross-subsidize. Open source models are good enough and cheaper. Chinese competitors price aggressively. Margins are under sustained pressure. And the business model requires billions in ongoing capital just to stay competitive. This is not a normal IPO. This is private investors exiting and public investors becoming the financiers of last resort. The people who made money did so at much lower entry points. What remains is an expensive bet on future profitability in a capital-intensive, highly competitive industry. The math is clear. The timing is clear. What you do with that information is your choice. Thanks for watching The Money Timeline.